Now in segment 5, we're going to look at Asia. We're going to look at stimulus in Asia, debt levels across not only just Asia, but how does that impact the rest of the world? And then what is trade and how is trade doing not only in China, but also in other areas? So the one thing to kick off, just because it came out recently, is the new Japanese stimulus. So here you can see what the situation is and the rest of the economic policy package and then the supplementary budget that's going to be used to backdrop it. So right now, Suga said financial measures in this package total about 40 trillion yen. So 40 trillion is that pink line, and then the supplementary is going to come from the budget level, which is going to shake out to about 73.6 trillion based on the way it's written. So it's the third extra budget. If the third extra budget is used to finance public investment, such as a plan to spend 5.6 trillion on public construction projects against natural disasters. So again, like that's where that piece comes in, where you're going to get more things that are going to be budgeted for essentially stimulus, which will be more infrastructure based. And the impact on growth could be even bigger than the 50 basis points that are viewed. So when we look at the Nikkei, so clearly the stimulus has sent everything higher, while the yen has essentially stayed flat. So again, it comes down to where is the U.S. dollar versus others, and you're continuing to see this push higher, but. The Japan is now I think the BOJ now owns about over 80% of the Nikkei and different equities. So this is an example, which is why I call it Japanification. Japanification this is where everybody continues to go. We are continuing to see the BOJ, as I showed in the first segment, the amount of stimulus they're doing. They continue to buy, they continue to purchase. They're actually running out of stuff to buy. And this is just another round of stimulus on top of what was already expected. As you can see, the other two that came out that were essentially close to about 113, 115 trillion yen. And now they still didn't have the Olympics. That's going to be a drain. Their taxpayers are going to have to pay more for that. So it's going to be very uncertain. And then how much revenue can you get if you can't have viewers, if you can't have people coming to the country, they're spending money, what does that look like? What is the cost? And then you already have people that have purchased the ability to market, to be sponsors. Are they going to re-up? And now you're getting close to the Chinese Winter Olympics, which is 2022. How much is this going to conflict? Because people are like, all right, well, I'm already invested in 2022. Do I really need you? And that's where the concern comes into how are we going to see this growth? And now it's interesting because household debt accumulations for the first 6 months of 2020, China is clearly off the charts as we've seen the expansion, but again, also a lot of people. So when you spread this across all the individuals, clearly 375 billion is spread across more people is going to be very different. But it's just going to show that when we look at the dual circulation strategy and what China is looking to accomplish, they want to build a more robust consumer, but yet they're essentially putting more debt on the consumer. And as people took out loans, credit cards, and others to try to survive COVID, we've still seen that essentially reside at the household level, which is just going to impact imports. Because when we look at China, and then we'll go into more detail on a supply recovery and a demand recovery. So exports have been robust. So if exports have been robust, that means that the companies are gaining more money because they're exporting more, which means that the salaries should continue to bleed down. They should be able to hire more people. Manufacturing should tick up, and then people will buy more, which will then increase imports. We're not seeing that. We're not seeing that movement through the system. Now, U.S., Japan, Germany, France, same thing where the household continues to build up more debt in order to essentially just survive to the other side of COVID to try to bridge some of that gap. But now when we look at, the Chinese trade with these countries, because you have the consumer, saddled with more debt, but Chinese trade with the U.S. and Europe, exports to the U.S., exports to the EU, and we'll go into more depth in a few minutes. But the exports to the U.S. continue to shift higher. They're now at all-time highs when we go in terms of the trade imbalance. It's at an all-time high as exports have increased. Imports continue to miss massively. But China's taking a bigger piece of the exporting pie. And that is going to annoy, or at least, it's going to drive countries and central banks to want to change that, because based on the fact that the global economy has shrunk, the growth is going to be negative. There's less pieces of the pie. The pie is smaller. And with China exporting more, they're taking a bigger piece of a smaller pie. And that is going to create issues in terms of how do people or how do countries try to close that gap. And that's why we're going to continue to see friction specifically on the trade side, even with the RCEP that was recently signed. So when we look at the Chinese trade balance, so let's take this from on a CNY level. So exports were expected to be at 5.7%, came in at 14.9%. Imports were supposed to be 60 basis points, positive 60 basis points. It came in at negative 80 basis points. So that's a problem, because negative 80 basis points. So you're going to import goods to build stuff, which you're then going to export. You also have 1.3 billion some odd people that need stuff, and you should import, or those people should want those things, because the wealthier Chinese also they don't buy as much Chinese goods as the government would like, which is why the dual circulation system is, if you go back to where we first covered it, quality is a big talking point in the Plenum structure. Why? Because quality is an issue. So people who are wealthy will buy foreign-made goods. So the fact that the imports remain down is showing that there is a problem on the supply level, as we don't see the movement through the system. And this is coming as the yuan continues to strengthen. So technically, it should make more sense to buy stuff because it's strengthening against the dollar. Things, the dollar's weakening, other currencies are weakening, so you should be able to afford more. That is not the case. And that's why when we look at the trade balance, you can see that the trade balance is huge. And the trade balance is also putting more cash on the foreign reserves. So instead of an expected 3.15 trillion, it was 3.178 trillion. Again, that's a small little piece that is good for a certain, essentially securing bad debt. It's good because it gives a certain amount of comfort that they'll be able to manage inflation, bad debt expense, and just a certain amount of backing and collateral for the loans that they've made. And you can see, just given now exports versus U.S. dollars were supposed to be 12%. It was 21.1%. Imports in U.S. dollars was supposed to be up 7%. It was actually up only 4.5%. So no matter how you look at it, there is a problem with the import side of the Chinese equation. And I don't think that gets enough play in terms of where is this going to go and what is that pain really going to look like. And here's where we look at China's trade surplus with the U.S. hits a record, and we'll go through how this is possible given where we sit in terms of the trade deal. And you can see we've broken to new highs. And as we've talked about, there's still a need to fill the inventories. We've seen some slowdowns. We've seen some issues at the coast. And as some of those issues at the coast start to alleviate, and these, let's call it containers and other things start to show up in China, they can then get refilled and then they come back. So again, there's bottlenecks on both sides, which will make this a little bit lumpy. And that's something to consider, especially as we go forward. So when we look at the next year, so more than $722 billion worth of Chinese stock will be unlocked for sale next year. Now, that's going to, testing a market where valuations are at 5-year highs. So if you've done an IPO, if you've gotten, shares, your lockup is going to expire. And based on the strength in the market, you will look to bring some of that money home, because why not? You've worked hard for it. Might as well look to try to bring some of that back. So this is giving you an idea of the amount of money that has been unlocked, and it's the most since 2011. So that would be the largest amount. It's the equivalent to about 7% of the value of the entire Chinese market. So just to give you an idea, from initial public offerings to additional placements, China's cash-hungry companies have been encouraged by Beijing to funds by selling new shares. So again, there's an incentive to then, not to say that it's just going to help cap some of the movements that we've seen over time in terms of the amount of stock, new stock coming to market that has to be absorbed. So then when we look at, okay, let's look at this a little differently. So now we're going to look at Chinese exports in US dollars. So where does the Lunar New Year timing come in? And if we think back to 2014 and 2018, 2014, we had there was a lot of stimulus coming into China. So China stimulated a significant amount. We had a huge shot up in 2015, and then we had a big drop in 2016 when we saw some of that stimulus start to go away, just because we've had that recovery. Then at the end of 2016, there was concerns of a big slowdown. And then we got another surge in stimulus, and that stimulus carried us straight through to 2018. And then in 2018, they walked back stimulus. And look at the exports. So right where we get these spikes, and now what have we done in 2020? We've gotten an increase in stimulus, not to the same level we have in 2018 and in parts of 2015, but again, enough stimulus where we're getting this drive higher in front of Lunar New Year. And the timing of it is very interesting as we look at the supply side of the equation. So November's trade data continues to show the lopsided recovery. The result is, so right now, trade surplus wise, so 75.4 billion or 6% of Chinese GDP was in exports. Now let's look at this on a global level. This requires a deficit for the rest of the world of nearly 1.2% of GDP. So how do you finance that? How do you maintain that? And that's either through an imbalance that is going to come from either maintaining the surplus and or a surge in public sector investment. Now, we know from the PBOC commentary, we know from what they're looking to do, they're looking to avoid some of these investments, some of this stimulus on the PBOC side, because there's already so much debt internally within China at 360% of GDP. Now, with GDP being driven so aggressively by exports, that creates some strife, because now you have these surging exports, which based on some of these charts could continue higher into Lunar New Year as you get this pushed through, and then you're going to get this bigger drop off. Now, the problem is going to be, Beijing is trying to limit that but without seriously rebalancing its policies. There's only so much that can be done. And this is what we've been warning about. And there's people on Twitter that we've been talking, that we follow, that we've been retweeting and talking with, that have a very similar view in terms of where some of those supply issues continue to come in, and why we continue to be so concerned on the debt levels of China. And taking this to the next level, what are the debt levels? So when we look at total bond issuance, again, coming through. So remember what we talked about if we go back to the surges in stimulus. 2015 was when we got a big year. So 2015, you can see we got a big surge of new issuance. So 66% increase 2015 versus 2014. We got a big move higher. Then what do we have in 2016? We got a big shift higher in 2016. Again, looking at these increasing surges of new debt. And now 2018 was kind of that blow off top where we continue to get these new issuance as new debt gets issued, new stimulus comes through. 2019 saw another increase, and now 2020 is sitting at about 20.4 trillion as of November. So you can see that the marked step up of just debt that's sitting. Now, given it's being issued in yuan, not dollars, that provides a certain amount of insulation because it's within the country. The exchange rate doesn't matter as much, but there's only so much that you can tolerate given the sheer size and the amount of stimulus that can be generated by issuing so much debt, because the PBOC is then going to have to go out and either purchase it. And we've already talked about all the different things that are currently happening to try to support these growth movements. And this is just an example of The amount of dollar bond sales hit a 7-month low in November. Again, trying to avoid the exposure to dollars as China and the U.S. remain in a trade war, in some friction with uncertainties into a Biden presidency. They're going to look to avoid U.S. dollar issuance, because if you have a U.S. dollar issuance, we can get you on the sweep vehicle, we can get you on SWIFT. There are a lot of things in which we can penalize, and then it'll make things very difficult for you. And that's what's being avoided. And it's the conversion is, instead of U.S. dollar based, do it yuan based. And given the fact that they've opened their economy to more foreign investors, there is a bigger pool of people that are looking to purchase. Now, when we look at Chinese monthly soybean imports, they continue to surge, maintaining record highs, which has also been able to kind of adjust some of their pricing, as we've seen CPI actually go pretty steeply negative. Now, when we look at soybean imports, you might say, oh, this is great, soybean imports, this is the amount of imports, but how much of it is coming from the U.S.? So when we look at the U.S. Phase 1 tracker, Chinese purchases of U.S. goods, you can see that we are way off as of October, and there's no way to close that gap. So the question is going to be, look, we know COVID was a thing. It was bad for everybody. Let's rehash and resettle on new numbers. Or is it going to be something where you guys were going out and buying goods? Why weren't you coming to us? And there's language in there that says that the U.S. has to make all purposes and try as hard as possible to make the U.S. price competitive. So as demand surges and prices go up for things like farm goods, they can say, well, no, you didn't do what you could. You were slow getting hopper cars. The costs were going up, so it was actually cheaper to go to Brazil. So there's a lot of incentives and things that are built in that can essentially be skewed in different directions. The net of this all is clearly there's going to be a miss that will be measured in $100 billion or $75 billion, which is going to be a sticking point as we go into a new presidency, where Biden has already said he's going to keep tariffs for now. He's going to keep the Phase 1 trade deal in place. And they're going to have to review what worked, what didn't work, and what can be negotiated for better terms, because clearly this missed the mark. And here you can see imports. Again, agriculture started to go to the upside, but we can see energy missed on a big way. Manufactured goods started to close the gap, but when we look at agriculture and manufacturing and energy, there's just a general miss that we just haven't been able to close that gap. And then U.S. exports, same thing. Manufactured goods, energy continue to miss the mark. Agriculture got much closer, obviously due to the surge of needs for corn, soybeans, as they've come to us, and bought the most they possibly could. And it comes to a point where then the prices got so high, then they went to other places. So even, because remember, the deal was structured on dollar value, not amount. So even though we've had a rally in prices, some of the numbers were set off of 2017 levels with a percentage above that. And that made it a fairly onerous to kind of hit those levels, which can be renegotiated. But again, it just goes to show you that we're not even close, especially on an energy and manufacturing goods side, which will be a sticking point going into the future. And this is just looking at the yuan and the Chinese economy as the global recovery continues to shift, because the currency is up almost 10% from May lows. And the PBOC has more they can do to try to weaken the currency. It's just they're a bit more aggressive. And I think at this point, the dollar is going to have to strengthen, and we're going to have to look at what is the dollar going to do versus the euro. So, but this at the same time, if you think about it, the yuan being stronger should have increased imports and decreased exports. Instead, you can see that didn't actually play out. So the fact that the currency should have gone further and imports still missed, I think speaks even more to some of the issues that are currently residing in the underlying demand section of the Chinese economy. And that's why when we look at Chinese currency reserves, so you can see the big drop down, obviously, as they got more involved in debt, as they stimulate the economy, they're continuing. And this spike also comes with the trade balance. But the issue is going to be there is a lot of debt sitting out there as they've seen, as we've continued to talk about defaults, rising defaults, spreads have gotten wider. Currency reserves are going to be important in terms of trying to give people some comfort that they're not going to be at risk if they invest in China and beyond. Now, when we look at, just to finish off with Japan in terms of things that have been done, the value of the BOJ's equity holdings has climbed to 45.1 trillion yen. Just to give you an idea of the amount of equity holdings sitting at the Bank of Japan, you can see that clearly the acceleration has only gone up. Unrealized gains, estimated value of ETF holdings excluding unrealized gains. Again, the trend is up, and this is what a lot of central banks have yet to do, which we are likely to see over the coming. I mean, not at these levels. I guess if the market pulled back 5%, there'd be calls for the Fed to do it. But it's going to be an interesting one. And now, as we start to look at Japanese economy, as we talked about with South Korea, when we saw some increases in cases, we're starting to see some concerns starting to arise, especially in Japan, as we look at exports continuing to struggle. Industrial production beat estimates, but still remains fairly soft. You're seeing that there's the expectation was for 47.9 and the actual was 36.5. So again, this is the fourth largest economy, Germany being the third largest economy. Again, these two economies seeing so much struggle continues to provide us with enough concern that we continue to talk about 2021, the exuberance that we see, the expectation for this huge amount of oil demand, but yet where is it? It doesn't appear to be there. And that's where we keep coming back and forth. So, I know we covered a lot. We want to thank you for staying with us. Hopefully, this was at least somewhat exciting, or at least something that was intriguing. If you have any questions, please reach out. My email is available. I'm on Twitter. Reach out in the YouTube comments. We appreciate all your feedback. And again, thanks for the support. So, what we have coming up, we have the primary vision frac spread count. And then I promise I will put together the frac spread count, not just that, but also for next week, why fracking is good for the U.S. in terms of just bringing down overall prices. And what does that mean for us going forward as a country? So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.